Every month, trillions of rupees move from individual bank accounts into the Indian equity market through automatic SIPs. A primary destination for this capital is the Parag Parikh Flexicap Fund. It manages 1.64 lakh crore rupees, roughly $20 billion. That is nearly twice the size of its nearest competitor. But over the last 22 months, performance flatlined. A bank fixed deposit returned 7%, while this fund delivered less than 1%. Despite this, total assets doubled. Over 95% of that new size came strictly from investors depositing fresh cash. For the fund house, this growth is highly profitable. They collect a 0.52% annual fee on direct plans, regardless of the NAV's trajectory. On 1.64 lakh crore, that is 850 crore rupees in guaranteed yearly revenue. When retail investors began questioning this stagnation, CIO Rajiv Thakkar published a letter to unit holders. It opened with, "TLDR, nothing changes. You don't need to read this." He went on to categorize critics as busybodies. It raises a specific question. Is this fund house lazily relying on its past reputation, or is there a specific contrarian logic behind this lack of growth? To see where 63,000 crore of new capital actually went, we have to look inside the audited monthly fact sheets from September 2024 and July 2026. Despite narratives of sitting on cash, reserves plummeted from a 25% peak to under 5%. Ignoring fears that AI would destroy Indian IT, they increased IT allocation from 6 to over 10%, buying giants like TCS, Infosys, and HCL Tech. The management thesis is that businesses will need service integrators to implement AI workflows. Instead of betting on a single AI platform, they bought the companies that will provide the labor to build the technology. They also moved into deeply defensive segments, accumulating gas pipeline stocks and commercial real estate trusts. These assets provide a 7 to 8% rental yield, which helps stabilize the portfolio when equity prices are flat. This capital was recycled from the momentum-driven winners of 2024. They completely liquidated holdings in capital market financial infrastructure, dropping Motilal Oswal and MCX from the portfolio entirely. The portfolio disclosures confirm a team actively deploying capital into discounted assets during a cycle of high market valuations. Beyond the strategy, there are physical constraints on how this volume of money can actually move. A fund this size cannot buy meaningful stakes in midcap companies without triggering hostile takeover norms or massive liquidity risks. This bottleneck forces capital exclusively into the top 35 largest stocks, changing the fund's DNA from a flexible hunter to a concentrated large-cap holder. Then there is the structural handicap imposed by the Reserve Bank of India. Because the RBI froze industry-wide overseas investment limits, new capital cannot be sent abroad. This has diluted the fund's famous U.S. tech allocation from 30% down to just 12%, removing a major historical performance driver. By its own success, the fund is no longer an agile vehicle. Legally and functionally, it has become a slow-moving, large-cap value entity. This defensive profile is reflected in its beta, a measure of volatility. With a beta of 0.60 and a portfolio price-to-earnings ratio nearly 40% cheaper than its peers, the fund is designed to experience significantly less drawdown during a market crash. Retail tracking apps show negative alpha based on a one-year snapshot, yet Morningstar awarded it Best Flexicap Fund in 2026. The ratings differ because one measures the immediate flatline, while the other looks at a decade of rolling risk-adjusted performance. For investors with horizons longer than 5 years, switching out during a consolidation period often proves counterproductive. The current contrarian bets in IT and gas need time to mature into their valuations. Leaving early is also financially punished by the fund's exit load structure. Investors face a 2% penalty for redeeming within a year, an aggressive barrier that keeps underperforming capital locked in place. Aggressive investors must recognize this fund's limitations. It should be paired in a 60-40 ratio with a smaller, more agile mid-cap fund to balance this large-cap value defense with growth. Asset management size is a measure of past marketing and trust, not future speed. The ability to survive lean periods in a defensive asset remains the ultimate test of an investor's long-term psychology.